New tariff threats from the White House weighing on North American markets. Let's get more from Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Chad, it's great to see you. Bloomberg argues that the market is reacting less to Trump's tariff threats, but certainly there is a cloud over equities today.
Oh, without a doubt. And I guess the reasoning for that is they believe that the consensus is kind of solidifying that eventually there'll be a deal worked out. They can extend the 90-day tariff exemption. The reality, though, is that the consumer here in the United States, from all of the conference calls that I've been listening to, from consumer staple to consumer discretionary, have been retrenching a slight bit. And overall, the immediate concern is that capital investment here in the United States may also decelerate.
Are you in the camp that says there'll be a U.S. recession? I know that's a very hard call, but would it be a good idea to avoid consumer discretionaries, for example?
Well, certain consumer discretionaries, that is the case, and others may benefit. So, for example, one may want to look at a company like Walmart or a consumer staple company like a Church & Dwight, which makes Arm & Hammer baking soda. Those are more of the defensive plays that may very well benefit from a deceleration. We are in the camp that the economy will decelerate, and it will feel slightly like a recession. Overall, you could see GDP growth grow at 1% to 1.5% this year, and that's a real significant deceleration.
That's it. Church & Dwight, yeah, you don't get duller than bleach, but the product, we do need it. I'm not sure if we could put up a 10-year chart, because I think that one soared, didn't it, during COVID, when we were all obsessively washing our groceries, etc. Yeah, it did jump, and it's still up. It is up from those levels. You have another idea for us, WW Grainger, GWW, on the New York Stock Exchange. Remind us what they do. Tell us why you like them.
So this is an industrial play. If there is a reshoring of factories and a more of a build out here in the United States, Granger is a supplier of industrial tools and industrial products in a more of a catalog sense. This company is growing around 3 to 6%. There may be some headwind when it comes to tariffs because they have over 10,000 SKUs within their catalog, but we believe that they'll be able to pass that along overall. So it's appropriately priced. It's the thematic again is, it's an industrial should do well over the next 3 to 5 years here in the United States. And again, it's a lower beta company that is a rising dividend with very little debt.
That's interesting. When you say lower beta, it's not one that investors flock into and flock out of when they're feeling broadly optimistic.
Without a doubt, it's not an NVIDIA here. This is, again, more of a steady Eddie type of name. And again, it's had a very good past history of managing through economic uncertainty in cycles like this. But the tailwind, again, is the reindustrialization of the United States. Even a monicum of that would bode well for this company.
Right. And not a huge yield, but I see they're in the habit of increasing the dividend pretty regularly.
Exactly.
Your final idea, Microsoft, fans of this company say they've got their finger in so many pies in IT that at least some of them are going to be big winners.
All right. So this is perhaps the safety trade on AI. We have owned this in our portfolio for over 10 years. And what we are seeing now is the transition to artificial intelligence, and how they will make their money is through, again, a subscription-based business similar to their software that they used to implement to corporations. This is going to be, we believe, a very strong tailwind for the next 3, 5, and 7 years. They have been investing a tremendous amount into data centers, AI data centers. We think that overall they'll be able to upsell their clients and customers, not only the large language model customers, but also when it comes to inference, which is effectively when you're on your AI app and you ask a question, they will receive revenues for that type of data feed. So overall, we think that this company could grow at an 8 to 15% rate over the next 3 to 5 years. That margins will hold in there at where they are today, and that return on invested capital will be quite ebullient.
Before we go, Chad, apparently there's an argument out there that in the past, people, when they're nervous about the market, have put money into Apple. They think, well, Apple has got 1 billion customers or whatever it is. What is and Apple was seen as such a steady Eddie in the stock market. Well, what is your view on Apple, though? Do they face a real threat to their franchise here from the tariffs, for example, and growing Chinese rivals?
Yeah, Apple, we don't currently own Apple, but I will tell you that the risk to Apple is not the product side, but of course where they manufacture it. The multiples, are in range with historical range, but the headline risk to Apple, like you've seen today, could dampen the multiple, the PE multiple. Overall, can they resource or move their factories to different regions of the country, of the world rather? Yes, they certainly can, at a cost. So there is a tremendous amount of headline risk within Apple. We prefer Microsoft at this point in time because of their ability to kind of to make, I think, great strides on revenues and earnings without having that type of headline risk.
Chad, always great hearing from you. Thanks very much indeed.
Thank you, Andrew. Have a great weekend.
You too. Chad Morganlander of Washington Crossing Advisors coming